So hi guys, my name is Alexander Sheffalo. Once again, I'm a risk and ops analyst here at Eightcap, and today I'm going to give my bi-weekly gold report and discuss its price action in reaction to Fed Chair Powell's testimony the last couple of days and ahead of Friday's BoJ interest rate decision and the U.S. non-farm payroll announcements. First, I'm going to cover some of the current fundamental factors you must consider when trading gold, and afterwards I'm going to get into the technicals and discuss gold's current price trends. Okay, so the major factors to consider during this week and for the few days to follow are, first, number one, the Federal Reserve's hawkish expectations are capping gains for gold price. In the prepared statements for a semi-annual testimony to Congress, Jerome Powell indicated on Tuesday that interest rates might need to go up faster and higher than previously anticipated. Powell added that the recent economic data from the United States has been stronger than expected, and the Fed is prepared to increase the pace of rate hikes to combat stubbornly high inflation. The markets reacted quickly and began pricing in greater chance of 50 basis point liftoff at the upcoming FOMC policy meeting later this month. This remains supportive of elevated U.S. Treasury bond yields and thus acts as a headwind for the current gold price. Furthermore, the number two thing to consider is the stronger U.S. dollar obviously will act as a headwind for gold. In fact, the yield on the benchmark 10-year U.S. government bonds holds steady near 4% threshold, and the rate-sensitive 2-year Treasury note is at its highest level since 2007. This in turn assists the U.S. dollar to build on previous days' massive rally and climb to a 3-month peak. A strong U.S. dollar will also contribute to capping the upside for the U.S. denominated gold price. Hence, it will be prudent to wait for a strong follow-through buying before placing fresh bullish bets on gold and positioning for any further intraday move. That said, a generally softer risk tone could lend some support to gold and traders and help limit their losses on the downside. Lastly, U.S. labor market data. Powell's testimony eyed for fresh impetus. The market sentiment remains fragile amid worries about the economic headwinds stemming from rapidly rising borrowing costs. Apart from this, fading hopes for a strong economic recovery in China and U.S.-China tensions temper investors' appetite for perceived riskier assets. Market participants now look to the Bank of Japan and Bank of Canada rate decisions, as well as U.S. economic reports featuring the release of the ADP report on private sector employment and the JOLTS job openings data. This, along with Powell's second day of congressional testimony yesterday, and the U.S. bond yields will influence overall the U.S. dollar. Apart from this, the broader market risk sentiment should provide some impetus to gold and allow traders to grab some short-term opportunities. Now, kind of looking at the chart here over recent days, obviously, on this first kind of channel we had predicted for a long time, it maintained this channel for a while before breaking out, and this is when I retraced the second channel on the upside. And it's pretty much followed this trend and briefly touched the top of this channel before the announcements of the last couple of days and last Friday before trending on the downside. And at the moment, gold prices bounced off the 1-week low touched earlier on Wednesday and steadily climbed to the A15 region during the first half of the European session yesterday. The price has edged higher today, this Thursday, but lacks kind of a follow-through buying and remains confined within the previous day's broader trading range, which was earlier in the day around this kind of region. Now, and kind of focusing more on the 1 hour, it's currently trading around 825 to 835 range, and it's extended its rebound, surpassing the 1830 mark, and at the moment it's at 1834 on the second half of today on Thursday. After the data from the U.S. showed a large increase in weekly jobless claims, the benchmark 10-year U.S. Treasury bond yield turned south, which helped gold gain traction. From a technical perspective, overall, bearish traders need to wait for a sustained break below round figure, which coincides with the 100-day simple moving average before placing fresh bets. The gold price might then accelerate its fall if it continues on this longer trend downwards near the 1775 horizontal zone before eventually dropping even further to 1740 region. And we'll kind of zoom out here so you can get that little perspective. On the flip side, and kind of in more reaction to this morning's data and price action, any subsequent move beyond the overnight swing high around the 1825 to 1835 could attract more fresh sellers and more buyers. A sustained strength beyond the latter could trigger a short covering rally and lift gold price towards the monthly peak around the 1858 region. This is followed by the 50-day small medium barrier, currently near the 1869 region, which should keep a lid on any further gains, at least for the time being. And without further ado, that concludes today's video. Thank you all for tuning in, and I'm looking forward to updating you again in 2 weeks' time.